If you are investing money, getting the best interest rate can help you save big money. Troy Sutton tells us how to get the best interest for you in this week's KTAB Financial Friday.
You ever heard the comedian that said, "I used to work at a bank, but then I lost interest"? Interest. Yeah, that's what we want to talk about today. If you're interested, we'll talk interesting facts about interest that might interest you. First of all, interest is defined by Investopedia as the cost of borrowing money. Think credit card, a personal loan, and the like. Interest is the amount of money charged on the loan balance. Conversely, interest can also be the rate paid for money on deposit in a bank, like a CD or a savings account. So let's talk about simple interest versus compound interest. For years, we've invested in my firm in a preferred equity loan that pays 6% simple interest. Now, what does that mean? That means if I give the company $10,000, they'll pay me $600 per year, and at the end of the term, give me my $10,000 back if all goes well. I knew going into the loan exactly what I would earn each month in a payment, $50 a month. So if I wanted income, that could be an option worth considering. However, I did not compound the interest, not in that example. Interest on interest, or compound interest, can grow your investments much faster. Now, here's a little bit of history. When Benjamin Franklin died in 1790, he left $5,000 each to the cities of Boston and Philadelphia. Each city was to create a fund that would last for 200 years. The needy could borrow from the fund at 5% interest, and after 100 years, each city could withdraw $500,000 from the fund and leave the rest to work for the next 100 years. Now, why did Benjamin Franklin do this? To teach the people the importance of compound interest. So let's take the prior example of the loan. Simple interest of 6% over 5 years on $10,000 equals a total return of $3,000. Now let's take this same $10,000 at 6% of 5 years, but let's compound the interest annually. In other words, we're keeping the interest inside the loan, and each month we're earning interest on a larger value. At the end of 5 years, we now have earned not just $3,000, but $3,625. That's 20% more than the simple interest over that period of time. So let's review some quick facts. Number one, time is on your side. The longer you let compound interest work for you, the more money you're going to have. Picture a hockey stick in your mind. That's why they say the second million is always easier to earn than your first million. It's a two-edged sword. That's the second thing. If you own a credit card and they are charging you compound interest, which they all are, then by George, get that paid off fast. Don't be on the wrong end or the wrong side of compound interest. Just think about our prior example. The third, you want compounding to occur as often as possible. Some accounts will compound annually, some quarterly, some monthly, some daily. And obviously, the more often you compound, the more money you will make. So make sure you know the terms of a loan or investment so you can correctly manage your expectations. Compounding isn't just for banks. Your investments in annuities, mutual funds, stocks, bonds, ETFs, index funds, and more can compound. For fun, look up a compound interest calculator to see what your future could hold with discipline, study, and an understanding of compound interest. See, there are three kinds of people: those who can count and those who cannot. Have a great week.
Thank you, Troy. If you would like to contact Sutton Financial Group for more advice, you can contact them at 2449 South of Willis in Suite 106. You can call them at 437-0709 or go to SuttonFinancialGroup.com.